Hello, welcome to Capital Sensei. Today, we're diving deep into a book that truly changed my perspective, not just on investing, but on life itself. We're summarizing Richer, Wiser, Happier by William Green. We'll explore the profound wisdom he gathered from interviewing the world's greatest investors, uncovering their secrets to mastering the market, and more importantly, mastering themselves to build a life of wealth, wisdom, and genuine contentment. Whenever we can, we try to answer questions and engage with your thoughts in the comments section. So as we go through these ideas, please feel free to share any questions that pop into your head, or even your own experiences with investing and personal growth. Your stories help create a community where we can all learn from each other. Now, when you hear the title Richer, Wiser, Happier, you might think it's just another book about how to make a lot of money. And while the lessons in it can certainly help you build wealth, its real genius lies in a much deeper idea. The author, William Green, spent over 25 years interviewing dozens of the most successful investors on the planet. People like Sir John Templeton, Charlie Munger, Warren Buffett, and Howard Marx. What he found was that the principles that make them legendary investors are the exact same principles that can lead anyone to a more thoughtful, disciplined, and fulfilling life. The book isn't a step-by-step guide to stock picking. It's a guide to thinking. It's about rewiring your brain to make better decisions, not just in your portfolio, but in your career, your relationships, and your personal development. It argues that mastering your own psychology is the single most important factor for success in any complex field. And there are few fields more complex than investing. So, let's unpack the core wisdom from these masters. Let's start with a fascinating idea championed by an investor named Monish Pabry. His central philosophy can be summed up in one word: cloning. Now, this isn't about some sci-fi experiment. It's about the art of intelligently copying what already works. Pabry argues that trying to invent a brand new, revolutionary investment strategy from scratch is not only incredibly difficult, it's unnecessary. The blueprints for success are already out there, left by giants like Warren Buffett. Think of it like learning to cook. You wouldn't walk into a kitchen for the first time and try to invent a new form of molecular gastronomy. That would be madness. Instead, you'd find a recipe from a master chef. You'd follow it precisely, learning the techniques, understanding why certain ingredients work together. Only after you've mastered the fundamentals by copying the best can you start to improvise and add your own creative touch. Pabry applies this exact logic to investing. He studies the methods of the greats, deconstructs their thinking, and applies their proven models. This idea of cloning is a powerful lesson in humility. It's about recognizing that you don't need to be a once-in-a-generation genius to succeed. You just need to be a really good student of the geniuses who came before you. Identify the best performers in any field. Figure out what makes them successful, and shamelessly, but intelligently, integrate their habits and mindsets into your own life. Don't reinvent the wheel when a perfectly good one is sitting right there, waiting for you to use it. From the power of copying, let's move to the virtue of simplicity and patience, embodied by the legendary Sir John Templeton. Templeton was a true pioneer of global investing. He bought Japanese stocks in the 1950s when most people thought Japan's economy was a lost cause. He understood that the greatest opportunities are often found where no one else is looking. His most famous saying encapsulates his entire philosophy: "The time of maximum pessimism is the best time to buy." This sounds simple, but putting it into practice requires immense emotional fortitude. It means buying when everyone else is in a panic, when the news headlines are screaming, "Sell, sell, sell," and when it feels like the world is ending. Templeton's genius was his ability to remain rational when the rest of the market was consumed by fear. He understood that fear makes things cheap. People will sell perfectly good assets for pennies on the dollar just to stop the emotional pain. Imagine a beautiful, high-end department store. Suddenly, a fire alarm goes off. It's a false alarm, but everyone panics and stampedes for the exits. In the chaos, the store manager announces a 90% off sale on everything, just to clear the building. The contrarian, like Templeton, is the calm person who walks back into the empty store while everyone else is running out. They get incredible bargains, not because they're smarter, but because they controlled their emotions. This isn't just an investment strategy. It's a life strategy. Avoid the hood mentality, and you'll find opportunities that others miss. This naturally leads us to the ideas of another giant, Marx, who is revered for his memos on market cycles and risk. Marx is a master of what he calls second-level thinking. This concept is absolutely crucial, so let's break it down. First-level thinking is simple and superficial. For example, this is a great company. The stock will go up. I should buy it. It's the kind of thinking most people do. Second-level thinking is deep, complex, and multifaceted. It goes something like this. Yes, this is a great company, but everyone else already knows it's a great company. Because of that, the positive outlook is already baked into the stock price, making it expensive. What are the expectations for this company? Are they unrealistically high? What could go wrong that nobody is thinking about? What is the range of possible future outcomes? It's about seeing the chessboard, not just your next move. Think about playing a game of poker. A beginner looks at their own cards and thinks, wow, I have a pair of aces. This is a great hand. A professional thinks, I have a pair of aces. What do my opponents think I have based on how I've been betting? What kind of hands could they have that would beat mine? If I bet a certain amount, how will they react? Is there a chance they have an even better hand? Second-level thinking is about understanding the game beyond your own perspective. Marx argues that you cannot achieve superior results without it. To beat the market, you can't just think what everyone else thinks. You have to have a different and more correct view. This requires a certain stoicism, an ability to manage your emotions and think clearly under pressure. It's about focusing not on what the market will do, because nobody knows that, but on managing risk and understanding probabilities. You accept that the world is uncertain, and you build a strategy that can withstand that uncertainty. This brings us to one of the most fundamental concepts in all of value investing, a principle championed by Benjamin Graham and made famous by his student, Warren Buffett: the margin of safety. This is probably the single most important concept for protecting yourself from loss, both in the market and in life. A margin of safety is simply the difference between the intrinsic value of an asset and the price you pay for it. Let's use a powerful analogy. Imagine you're an engineer building a bridge. Your calculations show that the bridge needs to support a maximum load of 10 tons. Do you build the bridge to hold exactly 10 tons? Of course not. That would be incredibly reckless. A single overweight truck or an unexpected stress factor could cause a catastrophe. Instead, you build the bridge to hold, say, 30 tons. That massive 20-ton cushion is your margin of safety. It protects you from miscalculations, unforeseen events, and bad luck. In investing, it's the same principle. If your analysis tells you that a company's stock is truly worth $10 per share, you don't buy it at $10. You wait until you can buy it for $5 or $6. That discount is your margin of safety. It means that even if your analysis is a little bit off, or if the company faces some unexpected headwinds, you have a buffer that protects your capital. It's the ultimate defense against an unpredictable future. And this idea extends far beyond finance. Having a 6-month emergency fund in your bank account is a margin of safety for your personal finances. Having a diverse set of skills gives you a margin of safety in your career. Even getting 8 hours of sleep and eating well gives your health a margin of safety. It's a universal principle of building resilience and preparing for a world where things don't always go according to plan. It's about not just surviving, but thriving in the face of uncertainty. Now, none of these strategies work if you're not constantly learning and adapting. This is the domain of another titan of investing, Charlie Munger, Warren Buffett's longtime business partner. Munger's core idea is the necessity of building a latticework of mental models. This sounds academic, but the idea is actually very practical. He argues that to understand the world, you can't just rely on knowledge from a single field, like economics. Munger famously said, "To a man with only a hammer, every problem looks like a nail." If your only tool is finance, you'll try to solve every business problem with a financial formula. But reality is far more complex. A business is a system influenced by psychology, sociology, history, physics, and biology. To truly understand it, you need to draw on the big, powerful ideas from all of these disciplines and weave them together into a mental framework, a latticework. For example, understanding herd behavior in the stock market is a problem of psychology, not just finance. Understanding how a business can scale and create network effects is a concept borrowed from biology and systems theory. By having a diverse toolbox of these mental models, you can look at a single problem from multiple angles and arrive at a much more robust and accurate conclusion. This is what it means to be truly wise. A critical part of this is what Munger calls knowing the edge of your own circle of competence. This is all about intellectual humility. It's knowing what you know, and more importantly, knowing what you don't know. The biggest mistakes in investing and in life come from venturing outside of your circle of competence, from getting overconfident and making bets on things you don't truly understand. A wise investor would rather miss out on a huge gain in a complex biotech stock they don't understand than risk a huge loss. This commitment to lifelong learning and intellectual humility is a recurring theme among all the greats. They are voracious readers. They are constantly seeking to disprove their own beliefs. They understand that the world is always changing, and if they stop learning, they will fall behind. This isn't just about getting richer. It's about staying engaged, curious, and mentally sharp for your entire life. It's a path to a richer inner world, not just a richer bank account. This leads us to a deeply personal and philosophical idea from Warren Buffett, the concept of the inner versus outer scorecard. This is a powerful question to ask yourself. Do you measure your success and self-worth based on your own internal values and standards, your inner scorecard? Or do you measure it based on the applause and approval of the outside world, the outer scorecard? Many people live their lives according to an outer scorecard. They choose careers to impress their parents, buy houses to impress their neighbors, and post on social media to get likes from strangers. Their sense of self is fragile because it depends entirely on external validation, which is fickle and uncontrollable. They are constantly chasing a moving target of public opinion. Great investors and truly happy people operate on an inner scorecard. They define their own metrics for success. For an investor, this means judging themselves based on their decision-making process and their long-term results, not on whether they beat the market in a single quarter or whether a television pundit likes their stock picks. They have the conviction to look wrong in the short term to be right in the long term. Think of an artist. An artist driven by an outer scorecard might paint whatever is trendy, chasing sales and popularity. An artist with an inner scorecard paints from their own unique vision, expressing something authentic to them, regardless of whether it's popular at the moment. It is often this authentic, inner-driven work that stands the test of time and becomes truly valuable. Living by an inner scorecard frees you from the psychological prison of needing other people's approval. It's a direct route to a more stable, authentic, and happy existence. The book also explores how many of these investors, as they've grown older and wiser, have embraced principles that are almost spiritual in nature. They talk about detachment, long-term thinking, and finding a game that suits their temperament. Take the story of Spier. He began his career as a competitive, sharp-elbowed investment banker, educated at the best schools and driven by an aggressive outer scorecard. But after discovering the wisdom of Buffett and Munger, he underwent a profound transformation. He realized his environment on Wall Street was toxic to good decision-making. The constant noise, the pressure, the short-term focus, it was all designed to encourage bad behavior. So he made a radical choice. He moved his family and his fund to Zurich, Switzerland, intentionally getting away from the chaotic heart of the financial world. He redesigned his entire life to foster calm, rational, long-term thinking. This wasn't just a change of address, it was a change in his entire operating system. He learned to be more detached from daily market fluctuations. He cultivated gratitude and focused on building meaningful relationships rather than transactional ones. The result? He became not only a more successful investor, but by his own account, a much happier and better human being. He learned that your environment shapes your thinking, and you have the power to consciously design an environment that brings out the best in you. Another great example is Tom Gayner, the Chief Investment Officer at Markel Corporation. Gayner's approach is the polar opposite of a hyperactive trader. He has an incredibly low turnover in his portfolio, meaning he holds on to his investments for decades. He sees himself not as a trader of stocks, but as a long-term partner in wonderful businesses run by honest and talented people. His investment criteria are simple and elegant. He looks for profitable businesses with good returns on capital that don't use a lot of debt, run by talented and honest managers, and available at a reasonable price. But the key is his time horizon. He's not thinking about the next quarter. He's thinking about the next 10, 20, or even 30 years. This long-term game allows the magic of compounding to work, both for his wealth and his wisdom. This patient, partnership-based approach dramatically reduces stress. He doesn't have to worry about every news headline or every little dip in the market. He's focused on the underlying quality of the business and the people running it. This is a profound lesson. Success doesn't have to be a frantic, high-stress sprint. It can be a calm, patient, long-distance marathon. You just have to choose the right race to run. So when we pull all these threads together, what is the ultimate message of richer, wiser, happier? It's that the path to financial success and the path to a well-lived life are one and the same. They are both built on a foundation of humility, patience, emotional discipline, continuous learning, independent thought, and a long-term perspective. These are not get-rich-quick tricks. They are get-wise-slowly principles. You need the humility of Monish Pabry to learn from others instead of trying to be a lone genius. You need the contrarian patience of Sir John Templeton to act when others are frozen by fear. You need the second-level thinking of Marx to see what others miss and to manage risk in an uncertain world. You need the defensive mindset of Warren Buffett to always demand a margin of safety, protecting yourself from the inevitable mistakes and bad luck. Furthermore, You need the intellectual curiosity of Charlie Munger to build a latticework of mental models, giving you a more complete view of reality. You need the inner scorecard of Warren Buffett to define your own success and free yourself from the need for external validation. And finally, you need the long-term, detached perspective of people like Spier and Gayner to play a game you can win. A game that aligns with your temperament and leads to peace of mind, not just profit. Each of these ideas is a powerful tool on its own. But when you combine them, you create a holistic operating system for navigating the complexities of both the market and life itself. The book makes it clear that great investing is not about complex algorithms or secret information. It is, at its core, a behavioral game. The enemy is not the market. The enemy is often ourselves, our own greed, fear, impatience, and arrogance. The wisdom of these masters teaches us to conquer that inner enemy. By becoming more rational, more patient, and more humble, we become better investors. And by becoming better investors, we are forced to cultivate the very virtues that make us better, more resilient, and ultimately happier people. The goal is not just to compound your money, but to compound your wisdom. The real return on the lessons from this book won't just show up in your brokerage account statement. It will show up in the quality of your decisions, the clarity of your thinking, and the sense of calm and purpose you bring to each day. It's about designing a life, not just managing a portfolio. It's a powerful reminder that the ultimate prize isn't just being richer, but becoming wiser, and, as a direct result, genuinely happier.